looking in a great mood. The Nifty up about 230 points, 21,927 at that level. Are we going to see 22,000 levels very soon? What's driving the markets? Let's take a quick look at what the key contributors are for the Nifty. And you're seeing PSU stocks doing very well. Adani Ports is having a great day as well on the Nifty. Tech is having a field day as well. So you're seeing quite a bit of push and responses to events over the last couple of days, whether it's the Fed meet now making it clear that you will have a rate cut possibly sooner than later is the inference from what Powell has said, or you have a market that's digesting the budgets and seeing that it's positive for PSU stocks. Let's pull up some of the gainers on the PSE index. NBCC having a field day today, nearly 17% up. SJVN about 10% up. NHPC, NLC, all of them doing very, very well in trade. Even on the lower end, BEL, Cochin Shipyard, Coal India, all having a great day. Let's see what rail stocks are doing this morning. And you saw a bit of weakness earlier with rail stocks. You know, there seems to be some sort of parity in understanding that continuity will be there in terms of capex and focus on rail. Jupiter Wagons, in fact, about 4% up, but that's also on back of numbers, to be fair. Texmaco also had a good set of numbers with improving margins and steady margins, which was key. That was one concern, that yes, these rail companies are getting order books, but are they going to be continuing to have those key numbers? Now, today we're focusing on Indian hotels. The third quarter numbers have been very good. A bit of record there in terms of EBITDAs. Revenues of the hospitality company were up 16%. Net profit was over 18% at 447 crores. Now, to add more context to these numbers, we're joined by Puneet Chhatwal, Managing Director and Chief Executive Officer at IHCL. Mr. Chhatwal, a very good morning to you. Great to have you back on NDTV Profit, and this time talking about the numbers. Would you say this is typical for a quarter three where you've had events, a great wedding season, holiday season, etc.?
Well, it is typical. Q3 is obviously the best quarter for the hotel sector in India. And we also benefit from that. In last year, the Q3 was also very good. But we are very pleased that this has outperformed the last year Q3 numbers by another 70 crores on the additional net profit. And last year Q3 also had a one-off, was a sale of a non-core asset, which added 33 crores to the bottom line. We did not have that this time. So all in all, I think adjusted for that, almost 100 crore improvement in the profit after tax obviously pleases the management.
So you had that one-off bump as well, but I want to understand strategically what has changed, because are these numbers sustainable is the question. You've had a double-digit consolidated revenue growth. Your asset management strategy seems to be driving profitability. Can you talk to us more about that?
So, as you are aware, we have a balanced portfolio. 58% of our portfolio is still owned and 42% is based on management contracts. But we embarked on a journey of very aggressive growth across all our brands. And in the last 6 years, we signed 150 hotels that got added to the pipeline, which today has around 85. 70 of these have opened, and almost all on a fee-based model. And that is really driving the not like-for-like growth every year and resulting in a margin expansion, which traditionally stood at an average of 13.6%, but now we have guided around 33%, which means 20% or 2,000 basis point increase. So there is a change in the business model. That's one. And by investing almost 2,500 crores in the last 5 years in our big machines and our key assets is driving the operating leverage. So the absolute amounts are still coming in a significant way from our trophy assets like Taj Mahal Palace in Colaba, the Land's End in Bandra, the Taj Mahal Hotel in Delhi, the Taj Palace in Delhi, the Palace proposition, the Lake Palace, etc. So all these assets are really seeing a lot of good growth, and so are our assets in places like, let's say, London, where we have invested significant amount of money. And there is space, more space for London to grow, because London has not been as strong economically, or UK has not been as strong economically in the last few years, as we've all read about it. And so is the challenge with US also. So I think we still have opportunities for good growth, good operating leverage coming from very important destinations like US and UK, which is doing well for us, but could do even better. So we remain, fairly optimistic of this journey being not only sustainable. I believe that the best is yet to come, and we can expect even better performance in absolute amounts in the years to come.
Let's get your take on what your Refar is going to improve to, Mr. Chhatwal, because there's been quite a big bump up year on year at least. You see these as sustainable, and any guidance there that you can offer?
We are looking at definitely a double-digit increase in RevPAR. The occupancy levels are increasing a lot, but all the changes we have done, especially to our Ginger brand, are beginning to show results, and they'll be very strong. The growth in our new businesses and newly reimagined, where we say Ginger is reimagined, so Ginger will grow at 30%. So the total of the portfolio will have a double-digit growth, but I see no reason why Ginger next year will not grow 30% of its top line versus the current financial year.
Just a last take, we're speaking with you a day after the budget. Not anything specific mentioned for tourism in terms of allocation, but definitely a vision there laid out by Finance Minister. We've spoken about how this is going to be the next leg of growth. Any comments there, Mr. Chhatwal, on how you expect a policy push to tourism to benefit you?
Well, I think history is a proof for this sector, for its resilience of 100 plus years, and its resurgence post-COVID is really a hallmark of this sector. The way it is contributing to GDP, the way it is contributing to jobs, direct and indirect, I think that will continue to happen. But tourism is also a beneficiary of the government's allocation of infrastructure spend. All the new airports, the new highways, the new high-speed trains coming, the Bharat Mandapam, the Yashobhumi, all these convention centers that have been developed should positively assist travel, tourism, hospitality and aviation sector. With 50 new airports coming, the number of airports getting doubled. So I think there is an indirect benefit and a direct benefit. I have been very constantly advocating for a full infrastructure status at the central level. That has been our one-point agenda only. We have said no money or anything, but to position the sector as a full infrastructure status so that both the sector as well as government spend are aligned and help in the growth of all the tourism destinations in India. And I am quite hopeful that this coming financial year, we will get that status from the government, given their stance on tourism and the way it got mentioned in the speech of the Honorable FM.
All right. Good outlook there. Remember, you have a demand-supply mismatch as far as rooms are concerned, or, in this country right now. More demand and less supply. So we need quality and maybe better price supply coming in. Thank you so much, Mr. Chhatwal, for speaking with us today. That was the management of IHCL on their numbers. Let's quickly pull up the stock before we hit a small break. It's been a good quarter for them and for the industry on a whole. So in positive territory, about 2% up. We're coming right back with a very special conversation with Neelkanth Mishra. Stay tuned.
there are budget conversations and then there are budget conversations, and this is the latter. Neelkanth Mishra, Chief Economist at Axis Bank, as well as Head of Global Research at Axis Capital, joins us right now on the show. Neelkanth, always a pleasure talking to you, especially post-budget. Thanks for taking the time out.
Likewise, Neeraj. Always a pleasure talking to you too.
What stood out for you, Neelkanth? The headlines are known, but I'm sure you've looked beyond them. Tell us what stood out for you.
No, what stood out for me was that the government is now, for the first time, at least I can see, embarked on a medium-term fiscal roadmap. And the fact that they are sticking to a 4.5% number that they gave in the years after COVID, and are actually doing what is textbook macroeconomics in the sense that as the private sector demand has started to pick up, they are voluntarily doing much more than what the market expected them to do in terms of fiscal consolidation is actually quite phenomenal. And I don't think the market has yet priced in the implications of that, the value of the predictability of the government footprint in the economy. And it'll be interesting to see what rating agencies think about it in terms of a government which is now pretty much drawn down, and by FY26 will have drawn down nearly all of the pandemic era stimulus, which is I think quite phenomenal. So it was a vote on account, and therefore not too many new policies, not too many tweaks to tax rates, but I think the fiscal measure, the message that the government gave was a very strong one.
Could you explain that, both the parts? One, that the market not pricing in it, because I'm sure you think at the first level and the second level as well, so the impact thereof. And that interesting point that you made about rating agencies, because it seemed like a budget which is also aimed to please that gallery, or not please that gallery, but send a message to that gallery.
No, absolutely. So let me start with the second one. See, the reason why India got included in the JP Morgan Emerging Market Bond Index this time was not because the government pushed for it or gave some concessions. It was because the global bond investors wanted India to be included. And this is where, if you give a strong signal, you show commitment, you show that you're disciplined, the market starts to respond. And I think that given where the fiscal trajectory in the developed world is, and given where the fiscal trajectory as per what the government has announced yesterday, India's is, I think the rating agency should not be waiting for the debt to GDP to fall to 70% 8 years later before they start making rating upgrades. So that definitely does warrant a relook in a very serious. In terms of what is not priced in, I would think about it on two fronts. The first is the 10-year bond yield. The yields have fallen. In fact, they have come off. So the market has responded to lower borrowing targets. But for some reason, the bond market does not think beyond the next 6 months or 1 year. And what the government has promised and is trying to deliver is suggest that the 10-year bond yields should be even lower than what the price decline or the yield decline yesterday was. And because, see, what happens for any economy when the government says that we are going to reduce our footprint voluntarily, even if the market didn't want us to, is that there is going to be, medium-term consolidation, and the absolute level of borrowing is not going to change. In fact, very likely it will come down in the next year because of inflows into small saving schemes. And that means that, the bond yields will ease off even more from what we have seen so far. The second implication of this aspect of this is for the private sector. And that's where I think we need to see some more response. I think the government has, in a way, responded to positive capex intentions, the rebound in the real estate market, by saying that, okay, fine, now we are going to give you more space and allow more funds for you to borrow and use more of the domestic savings. So this is something that, again, from a growth perspective, is medium-term positive. So I was quite surprised that some of this was not showing up in the markets today. Perhaps some of the bullishness we are seeing today in the Indian markets reflects that, though of course, the US market rebounded last night as well. So it's very hard to say that is the reason.
Point. In some sense, Neelkanth, yesterday, the message that we drove, I wrote a piece about it on LinkedIn as well, about it at least to my mind, looking like a bond budget. But I didn't want to dwarf the impact that has on equities as well. I'm just trying to understand, because you made this point, the resultant impact of all that the government fiscal measures have done yesterday, is that a very strong positive for equities as well over the course of the next 12 to 24 months?
Well, the near-term answer is no, right? Because so as you can imagine, if the government pulls back on the fiscal deficit, so if, say, we expected 5.3, there were some people at 5.5 as well for FY25, and the government does 5.1, that's 0.2% of extra spending in the economy, which is not going to happen. And if you assume that all of it was going to add to growth, or the fact that it's not happening will take away from growth, you brought down the growth number by 20 basis points or 30, 40 basis points, depending on who is where. So this is bad for near-term growth. But from the perspective of the sustainability of medium-term growth, I think this is phenomenal, because what this shows is that the government is targeting macroeconomic stability, the predictability of interest rates, predictability of exchange rates, the predictability of growth in many ways. See, if you are stuck at a 80% plus debt to GDP, the ability of the government to respond to shocks, right? So just like what happened when the pandemic occurred, the government was trying to go from 73% to 60%, but in the process, because lockdowns had to be enforced, it actually went up to 88, 90%, and then it has been dialed back to 82, 83. It has to be brought back to 70. Now, what if there was another shock, which is unexpected? Does the government have scope for that? And it is, I think, very prudent of the government that when the economy is starting to do well, to actually start to create space for that already. And that means that your medium-term growth path is a lot more secure this way. And that should warrant, I think, much more bullishness from the PE multiple side. Though near term, we're thinking 6-12 months, this is obviously a headwind to growth. In fact, some of the questions I got asked by investors yesterday is that is the government doing too much? That we already have tight liquidity, we have elevated exchange rates, we have a slowing export situation. So is the government doing too much? And my response to that is, look, the government seems to be calibrating it, right? So in FY23, they consolidated by about 50 basis points of GDP. In FY24, they seem to be reducing the deficit by 60 basis points. And then there is a 70 basis point reduction that they're targeting in FY25. It suggests that as the economy is showing that it can absorb a 60 basis point consolidation, they're trying out with a 70 basis point consolidation. So I think it's wise and prudent. Let's see how it plays out.
Yeah, no, pertinent point. Neelkanth, in some sense, do you think this predictability is being done? It's a nuance, but I'm just trying to understand. In the minds of the government, I'm asking you to kind of peek into that. But do you think this predictability is being sought out at the cost of growth, or at the cost of growth, or with the confidence that the government has done the heavy lifting for the last 3 years? It has done what it could. It's drawing the boundaries, and now hoping for the private sector, state capex, household capex maybe, to take shape and form, and is confident that it will come through. What do you think is the choice?
Yeah, so it's a bit of both. So I would say that whenever so suppose you can travel at 100 kilometers an hour, but you know that there could be bumps on the way and the car could get damaged, you'll have to be forced to slow down very sharply. Instead, you travel at, say, 80 kilometers an hour, 70 kilometers an hour, and you think that you can sustain it for much longer. That compounding effect and that certainty actually triggers much more of private sector activity, because now the private sector knows that this is the direction of travel, that when I'm setting up a factory, I can reasonably think of a 7% growth. It's not that this year we are seeing 8 and the next year we start to. So I think that stability, that predictability over a medium term actually can be a growth positive, even if you are sacrificing it in the near term.
Neelkanth, what about What about the implications for risk assets? Now, I mean, kind of the bond market seems to be a given because of the budget plus the fact that flows plus lowering rates, etc., so on and so forth. So because I have time for one more question, I'll dwell on the equity side and not on the debt side. And I know you mentioned that the near-term challenges but medium-term positives. I'm trying to understand over the next 12 to 18 months, we are staring at a period of elections, not just here but in the US. There being some bit of uncertainty, but India is standing out at a bastion of growth in a world which is probably grappling for one. But we have the valuation issue. Is that issue large enough for money not to come in from the global side? The domestic money is fine, but the global money, is that issue large enough for global money to not come by? Or in your conversations, you reckon people are sanguine about the prospects?
See, I will reiterate what I've been saying for a while, that the foreign flows that come in are coming in mostly through EM funds, global funds, Asia funds, BRICS funds, and funds like that. India dedicated money in the mutual funds and hedge funds flows is actually only about 15% of the total. So there is, 1/3 of FII holding is through sovereign wealth funds and endowments and all that, and which have a very long-term strategic view on India, which I think is going on in the public markets at least. And the rest of it, the rest of the 2/3, nearly 85% is actually India allocations from global funds and EM funds and Asia funds and BRICS funds. And when you think about that, you realize that it is when EM funds start getting inflows that India will get inflows. So December was a time when EM funds saw a gush of inflows because the global markets realized that the Fed was going to perhaps cut rates and that 10-year bond yields fell because of the right reasons, what market thought was bullish reasons. And then January, when 10-year bond yields went up from 3.8 to 4.16, that money started going out. So I think we have to see the global cost of capital allocation to risk assets globally when we are thinking about the changes that happen to flows to into India. But by and large, I think there is acceptance that India's growth is resilient and that there seems to be a lot of focus on macroeconomic stability and predictability. One last point I'll make is that every investor I have met finds India to be expensive, and which is one way of saying that the market will likely stay expensive. Because if people are being honest about their views on the market, the moment India becomes slightly less expensive, they'll start coming in. So my sense is that that flows are dependent on what happens to EMs or Asia as a basket, as well as perhaps how fast our earnings can benefit on the roll forward basis.
We're completely out of time, Neelkanth, but can I just ask a follow-up here? In some sense, are you saying that the revival of confidence in Chinese markets is important for EM flows to come into India as well? Because that can't happen without China getting the confidence back.
100%. And so a lot of people tend to paint it as a China versus India thing. Economically, there could be some such arguments you can make, but from the financial flows or plumbing of financial flows, it is China and India, not China versus India.
Well, thank you, Neelkanth Mishra, for joining in today. I look forward to having you in our studios. We haven't done that, so maybe we can try and do that in the next 3 months.
I look forward to that too.
Yeah, but lovely talking to you. Thank you.
Same.
All right, that's an important view, both from a budget perspective as well as the comments that Neelkanth Mishra made on the markets. I think the standout for me today was him saying that India got included in the bond markets not because India wanted it, but because global funds wanted it. And it's imperative now upon the rating agencies to relook at their ratings on India. Well, the markets in fine fettle up about 1%, not quite at 22,000, but let's see if we do that during the course of the day. Thanks so much for watching this show. Up next is the FNO show and some earnings conversations.